And now I would like to introduce the Managing Director of Macarthur Minerals, Joe Phillips. Joe Phillips was previously the company's CEO in 2015 and also in 2020, and was responsible for the original funding and development of the company's significant iron ore assets, having completed its 2012 pre-feasibility study for the Ularring Hematite project and obtaining environmental approvals. Mr. Phillips was educated at the University of Queensland. He combines strong project management skills with a discipline in economics and a detailed understanding of the operation of public administrations and the elected governments in Australia. And so, Joe, I'd like you to bring you on now to say a few words to everyone here on the call.
Hi, everybody. Thanks, Neil. Am I on the line?
Yes, you're coming through loud and clear.
Yeah, thank you. Yes, thanks for your comments, Neil. Look, some shareholder yesterday jokingly sent that photo that you're using of me in this presentation here and said mutton dressed up as lamb. I thought that was fairly cruel. But anyway, look, I've only got a few minutes, and my key points here are we've come a long way in 12 months. The transition to Andrew Bruton was very important. I've been with Macarthur since 2009. It's been a long journey. It's been a hard journey. We've invested a lot of time and effort in getting it where it is today. We're just about at the across the finish line, and Andrew's the man to do that. In sporting terms, Macarthur needed a fresh set of legs. The mutton dressed up as lamb analogy is possibly true. I mean, I'm heading into my 60th year, so Andrew's a lot younger than me, a lot smarter, and a lot more enthusiastic. So I've known him for over a decade, and he's the man for the job. And a person needs to know their limitations, and I'm one of those people, and I'm really looking forward to a great year with Andrew. That being said, I'd like to welcome people here today. I see Peter Volpe's here today. Thanks, Peter, for your ongoing support. I met you about 2 years ago with Neil over lunch. Reid Rubin signed in again, and whilst I lament my 60th year, Reid Rubin tells me he's turned 85. So congratulations, Reid. And Frank has been chasing me down, and Frank's on the call. And Rory Kirkham, he regularly emails me and seeks an update, and he's on the line. And Dale Hauser from Raymond James, hi Dale. Sean Maverick, our advisors out of New York with Eddie Sugar and EAS Advisors. Hi guys. Sheehan Burns is a new face, and Neil's been introducing me to him. Gordon Larson from Paradigm, thanks for your support and research. And we've got a guy who's been with us a long time called Bill Weatherly from Biloxi, Mississippi. Hi Bill, and thanks for your ongoing support. So look, that's it for me. I just wanted to put a few Cheerios up. Macarthur's got a long list of very dedicated and faithful investors. In actual fact, I'll give you the numbers. In Australia, we've got 594 new investors that joined the register when we listed here in Australia. In the US Novos, we've got 310, of which Bill's one of them. In Canada, we've got 910 Canadian Novos, which is non-objecting beneficial owners and shareholders. And the OBOs, which is the objecting beneficial owners that sit behind custodians, we really don't know who they are. But I work on the fact that we've got about 3,500 to 4,000 investors globally. And, I'm very proud of the work that's been done to date. And it's up to Andrew now to really deliver the project on behalf of our 4,000 plus shareholders. Okay, thanks very much, Neil. Thanks. I was just doing a cameo. I'm still around. I'm still driving value. Stick with us. We've got a couple of really interesting spin-out opportunities that are coming out of Macarthur in the next short while, which will be beneficial to shareholders. Thank you.
Awesome. Thank you so much, Joe. And now I would like to introduce Andrew Bruton, the CEO of Macarthur Minerals. Andrew has a background of over 20 years of top-tier professional experience in corporate, mining, energy, and infrastructure law. He has been recognized as a leading transactional and project lawyer in the mining and energy sectors in Australia. In senior leadership roles, Andrew has been responsible for large teams at both state and national levels. He's also an experienced company director, having advised major Australian and international mining and energy companies on complex projects and transactions with multi-billion-dollar values. Andrew has a deep understanding of these markets. As a strategic thinker and leader with strong business acumen and a focus on delivering outcomes, he brings a wealth of experience to Macarthur Minerals. Andrew holds a Bachelor of Laws and a Bachelor of Business Accountancy from the Queensland University of Technology. And so, Andrew, I would like to bring you on now so that you can begin the main focus of our presentation today.
Thanks very much, Neil. Can everybody hear me?
Yes, coming through loud and clear.
See me? Great. Well, thanks for that, Neil, and thanks, Joe, for those kind words of introduction. It's a shame that a couple of the bottles of wine seem to freeze over there. I'm on the water this morning, but it's a chilly 29 degrees Celsius here. What's that in Fahrenheit? About 84 degrees over here. So we don't have that problem. But I'll have a glass of wine after this tonight. Look, I'm pleased to be with you all today, and for the opportunity that Investor Cubed have initiated to allow us all to get together in the forum here. I think it's a unique event. We've done a number of these before, and Joe's presented at those, and this is my first time, so I'm looking forward to sharing some of the information with you about Macarthur and our plans for 2021, and taking some questions at the end. So I might, Jordan, get your assistance maybe to flick through some of these slides. The first one is the disclaimer on the second slide. If we can get that one up. So I won't read that verbatim, it's just on the usual terms. It's obviously a presentation for the Canadian market, but there's nothing contained in this that's going to cut across information that hasn't been disclosed. So we might move straight on to the fourth, which slide are we on now? On the corporate overview slide, slide 6. There's a number of things I'll step through today, and I'll try and be as efficient as possible so we've got time to take questions at the end. But just a little bit of a snapshot about the company. You can see from the slide there, we've got a brief snapshot of the capital structure and the financials on this slide. Those details were current last Friday. I think we were trading at around 64 cents on TSX and ASX last week. The markets are synchronising reasonably well. Both markets have been trading in similar ranges, although TSXVs at times over the last few months seem to lag occasionally. I think it's certainly now picking up and it's leading, which is really pleasing to see. We hit closing highs of I think about 74 cents and 64 cents last week on ASX, the ASX, and about the same on Canada. So I think we even got up to about 67 cents over there today. So that gives us a market cap of around about 90 million. And you can see on the chart there that the upward share price trajectory has been solid and sustained over the last 12 months. Like every other company on the planet, we got battered by COVID at the start of 2020, and that was pretty short-lived. But the recovery's certainly been led by an uptick in the iron ore price through that period. Our share price performance is more closely linked to the market's perception of the company's performance against targets and how well management's executing against that strategy to steer the company closer to a bankable project and first production. So, let's face it, investors want to see tons out of the ground. That's the evidence of success. That's the bricks and mortar. It's going to underpin the material re-rating of the company. And the closer we get to that point, the more confidence will build around us. And I'll talk more about our target production trajectory a little bit later on. Look, we've had a very active period of positive news flow during the year, and during the course of that period, we've, as Neil said, look, management's tried to deliver against all of the targets that we set out to achieve. I don't believe in pushing out news for the sake of pushing out news. You see a lot of juniors doing that, but I just think that becomes an annoyance for people. So we've made material advances on our route to market. We've secured an MOU with the Esperance port. We've undertaken a financing round, just to name a few. We hit the 100 million market cap point last week at one point, and we're continuing to hover around it. And I think about 15 months ago, we were trading on TSX at around 8.5 cents with a market cap of under $10 million. So it's a really significant movement over a short period of time, in my view. And that 100 million market cap level is the point at which you start seeing a greater level of interest from institutions. Some people who have been around with the company for a while would remember, but newer ones perhaps wouldn't remember that the company had a market capitalisation in excess of about 200 million a few years ago, and that was at a stage where the projects were far less advanced. And I think, given the size of our magnetite and hematite resources and the additional work that's been done over that period, and the fact that we're in full feasibility study mode, in my view, we're seriously undervalued in the current market. We've got about 6 million in the bank. We've got a 20 million controlled placement finance facility that gives us some significant underlying strength to our balance sheet if we choose to utilise it. So we're in a solid financial position going forward with the ability to operate as a going concern and to meet all of our current forward expenditure commitments. On the equity side, we've got around just under 140 million shares on issue, about 45 million warrants, about 3.3 million restricted invested units. So that's equates to probably around about another 13 million of additional equity funding we could potentially access during the next period. On to the next slide. Thanks. So look, there's that slide will come up in a second. Might be a little bit of a delay. Look, I just want to give you a little bit of a case study here. There's been a lot of comparisons made between the trajectory of Champion Iron and the prospective opportunities that lie ahead for Macarthur investors with our high-grade magnetite project. And look, I'll caution on direct comparisons as I ought to. There's never a guarantee of correlated performance, and there's always there's clearly differences in the project pathway for Champion and what we're looking to do in Western Australia. The main one being that Champion's Glen Lake project was a restart and it benefited from some legacy assets. Our project at Lake Giles is greenfield, but we've got the benefit of potential access to established rail and port infrastructure within reasonably close proximity to our tenements. Their stage 1 feasibility study was targeting a similar initial production volume and had a similar capex target to our own. And when Champion delivered their feasibility study, it triggered about a 300% boost in their share price. So there are certainly some parallels in terms of the potential share price growth at various points, similarities in project size and product grade. They also had Glencore as a backer and an offtake partner. And so when you look at the two companies and you look at companies like Champion and where they were relative to where Macarthur was prior to completion of their feasibility study and commencement of production a few years ago, I think it's reasonable to look at those share price boosts and where they occur and say, well, that's a trajectory that could be tracked against Macarthur. The chart on that slide, this slide you're just seeing now, tracks Champion's trajectory, and I've put a marker on the timeline showing where our project is at now. We're just at the point of getting to the point of delivering our feasibility study. So all of you will be aware of the Champion story. They've currently got a market cap in excess of $2.5 billion and a share price of over $5. So look, the jump point initiatives, and we're going to have a very conscious eye on what investors are seeking. One of those I mentioned in an interview that was earlier this week on the Market Herald was that we're making the move back up onto the main board of the TSX. I think that's something that the market's been waiting for, so we'll be starting a process around that. The other one is our objectives around a move into potential early production of DSO, given where the iron ore product is currently sitting. If we can move on to the project overview slide, please, Jordan. Slide 9. Look, I'll just circle back and give a quick overview of the project fundamentals for the uninitiated. I know there's a lot of people who've been with us for a long time that understand it well, so I'm not going to go into it in a huge amount of detail, but I just want to put some context out there for those who haven't, who are more recent entrants to the Macarthur story. Our flagship project is the Lake Giles Iron Project. It's near Kalgoorlie in Western Australia. It comprises the Moonshine Magnetite Deposit and the Ularring Hematite Deposit. So we're focusing on our high-grade magnetite project, targeting an export solution via existing rail through to Esperance Port. We have a 93-kilometre haul road application lodged from the location of the Moonshine deposit to the rail line, and we've also applied for an area to construct a rail siding, which will be just to the east of the existing MRL rail siding at Jowdy. And from there, it's about a 503-kilometre rail haul to the Port of Esperance, where we're proposing a unique rail unloading solution, which I'll discuss later. I've already mentioned the fact that in 2019 we signed a binding 10-year offtake agreement with Glencore, under which they agreed to purchase up to about 4 million tonnes with an option to extend for another 10 years. So that covers off where we're going in terms of sales. It's a landmark agreement for us, provides a guaranteed market for our product and no credit risk on sale because we're getting paid at the ship rail for the product. Glencore very carefully assessed our project over a period of many years, and many of you would know they also backed Champion, and they've got a seat on the board there. So we've got a project expect can be delivered at a specification where it can be marketed alongside the Champion product. We've got a great relationship with Glencore, with its global iron ore division in Zug, and we regularly speak with them. And they supported us in our convertible note in 2019, and they remain a great source of technical and marketing support for us. So our objective is to keep developing along our journey with project partners of a similar calibre. On to the next slide, please, Jordan. Thanks. So what are we sitting on? Well, in our view, we're sitting on one of the world's largest undeveloped magnetite projects. They're 100% owned by us with fully granted mining leases. We've got no native title and cultural heritage issues. We've undertaken advanced work on environmentals. We completed our measured resource statement for phase 1 last year, as many of you would have been aware, and that provided us with sufficient resources in the right categories to support our current feasibility study. We've got just under 54 million tonnes in the measured category. We've got it's using about a 30.8% cutoff grade, which will beneficiate up to a plus 66% iron concentrate, and we're targeting a P80 45 micron product, but the final grind on that could go a little bit lower. The resource is showing a high mass recovery of between 45 to 50% from initial low intensity magnetic separation test work of moonshine, and it's highly magnetically susceptible, so it separates very well from the Gange material. It's also got very low levels of impurities, which means it burns cleanly. Magnetite, unlike hematite, got an extra oxygen molecule on it in it. Joe's spoken about this at length on a number of occasions to many of you. Its chemical composition is FeO3, so in flashing off that extra oxygen molecule in the furnace, it generates a lot more heat, so it's more fuel efficient in the furnace, and it requires less coking coal. It's also the only form of iron ore which is suitable for use in electric arc furnaces when combined with scrap material, and I'll discuss the significance of the global transition to that shortly, because that's important in terms of where value is heading. We could produce a product of between 68 to 69% iron, but interestingly, the advice that we're getting from Glencore and others is that there may not be much point in spending the extra money in initial capital and OPEX to squeeze that extra 2 or 3% out, because there's no benchmark spot premium for a plus 68 product at the moment. So at this stage, our objective is to target a plus 65% product, and we would obviously review that as the market dictates. We've also got about another 220 million tonnes in the indicated category, and a further billion tonnes in the inferred mineral resource category. So you can see from the map on that slide there that the area where we're targeting for phase 1 of the magnetite operations is the Moonshine and Moonshine North, and they're delineated by the green areas. You can see just there at the bottom of the map. Next slide, please. So what's our proposed mine development going to look like, and what's our current target time frame? Well, we're targeting a production of around 3.3 million tonnes per annum on a wet basis. So it contains about 8 to 10% moisture at a concentrate level. And we'll have the potential to scale up operations into the future. And with the resources I've just outlined, we've got the potential to be a generational supplier of high-grade magnetite. We've got our feasibility study well underway, and we're expecting to complete that this year. That'll be a big milestone for the company. It's a complex study that involves a lot of different components, and I'll speak more to that shortly. We're anticipating an 18 to 22-month target construction period for the mine build-out post-completion of that study and closing of project funding. And that places a first commercial shipment date of around Q1 2024, and we're tracking to that date. Next slide, please, Jordan. Thanks. Look, to give you a bit of an understanding of the different components of the project leading up to completion, I've set out a high-level summary there, which gives you a bit of a breakdown of some of the critical components. Offtake, as I mentioned earlier, with Glencore is already done. That was signed and negotiated by Joe in Switzerland in 2019. So I've already talked about that. That's completed, and that's material. Our measured resource statement, we got that out last year, so that now underpins our feasibility study. That's completed. En route to market, our route to market components are set out in the next stack, and we're well underway to achieving a secure route to market for our product. So I've listed the key components there, but of course, we've also applied, as I said before, for a haul road and rail siding to get our project to the rail line. On the below rail, last year, you would have seen we announced we received a proposal from Arc Infrastructure for indicative track access pricing for the below rail paths that we need to get our ore to Esperance. And that included a clear pathway to achieving a binding commercial track access agreement. So that's now well underway. Above rail, we're in discussions with above rail service providers, and we've received indicative pricing and required above rail paths to support the haulage as well. So that's well underway. And the final component of our route to market is port access, and the memorandum of understanding with Southern Ports that was announced last week is a very important development, and I'll discuss the significance of that and the positive implications for our project in the next part of the presentation. So I'm now very comfortable with the position that we're in with the port. And look, I'll be clear about it. Resolving the route to market puzzle in this region of Australia has complexities to it. It's not just about putting product on a train set and waving it off. You need to have a full operating plan from pit to port. You need the right infrastructure support. You need to deal with multiple counterparties and stakeholders and other competing interests in the region. And in that sort of environment, you can only be successful if you adhere to principles of open access and deal with counterparties who are willing to do the same. Now, with the background I've got in large-scale port and rail projects, I certainly understand what's required to achieve the outcome we need, and I believe that we've negotiated a process that can support that. On the feasibility study, progress with that is continuing, and the work's well underway on that, on some of the main packages of the work of the study. I'll just talk about that separately in a moment. Following on from that, we'll be doing our detailed engineering work following completion of the study, and then financing. Of course, we're continually engaging on finance throughout the whole process, and that's critical because we're targeting completion of our financing for the project as quickly as possible after the feasibility study is delivered. So we're in continual discussions with groups and interested groups through our advisors so that we're well prepared and that we understand the terms that they're going to be seeking and the risks that they're going to be interrogating, so that we're fully up to date and understand. They're fully up to date in terms of understanding our project. The next slide, please, Jordan. Thanks. Look, the one thing I want to touch on in terms of route to market, and I think I know there's been a lot of interest from investors, is the issue of the Port of Esperance and the progress that we're making there. The big plus for our project is the fact that we've got established regional rail and port infrastructure. And what I want to focus on here, as I said, is Esperance. So the Port of Esperance is an established deep water port. You can see an aerial shot of it on the slide there. It's absent some details about the specifics of the location of our planned infrastructure there, namely the Helix dumper and the conveyor network that'll feed into a 3 kilotonne iron ore storage shed. And that's because those details are still under negotiation with the port. But you can see the location of the proposed storage shed there. It's accessible by the rail network. It can handle large Cape-sized vessels. So Cape-class vessels can handle up to about 170 to 180,000 tonnes of ore. They're big. That's a lot of ore. It's a port that's owned by the Western Australian State Government and managed by the Southern Ports Authority, and it's currently handling about 8 million tonnes of iron ore a year. And there's the potential to increase the utilisation of the existing ship loader on berth 3 to support the additional throughput with the rail unloading and operational enhancements that we're currently negotiating. At present, that bulk iron ore ship loader on berth 3 has got sufficient uncontracted design capacity to meet our phase 1 project outputs, where we can reach agreement on an effective unloading and operating solution. So with this MOU, I mentioned we signed a few weeks ago, investors would have taken away it's a non-binding document, and that's correct. But what you have to understand is how the progression of access arrangements and agreements for major state-owned infrastructure assets work in the context of large resources projects. Unless you're a BHP or a Rio Tinto that's looking to build or invest new port infrastructure from scratch and you're funding off existing balance sheet, it's not logical to expect you're going to receive a binding and unconditional capacity agreement ahead of completion of your definitive feasibility study to support your project funding. But what the MOU does represent for Macarthur, and what management have been spent a very considerable amount of time and effort on during the course of 2020 and 2021 with Southern Ports, what it's done is it's achieved exactly what we need to move through our feasibility study for the project, and that's a pathway to agreeing an acceptable infrastructure and operating solution. So that we can then negotiate and enter into the necessary tender and capacity arrangements that can support the export of our ore. So those agreements will necessarily be conditional upon a range of things occurring. That'll include the completion of the feasibility study and funding. And I believe it's achievable to have those more definitive agreements in place before the feasibility study is complete. And that's what we're going to be targeting in collaboration with the port, certainly a position that we're aspiring to achieve under the MOU. But it's still sufficient if those agreements are in place before financing occur. And if you look at the Champion Iron Ore timeline, that's precisely when that occurred for them. So we're no different from that. We'll certainly be discussing optionality for expansion capacity from the Helix dumper as part of the future negotiations. We're committed to the principles of open access when it comes to new infrastructure there. And I think that our approach on that, striking a pretty fair balance between Macarthur's objectives and being a responsible, valuable long-term customer at the port. Of course, with increased third-party utilisation of that unloading circuit, it will certainly actually lower our operating costs over time. There's a new master planning exercise that's underway at the port at the moment, so we're doing this work with the port, I think, at the right time. Yes, there's been a series of master planning processes at the port in years gone by, but the difference this time around is that we're taking more of a role of an active collaborator on the engineering and operating solution that specifically meets our needs. So we're being very specific about what we need, and we're not asking for the port to pull out a checkbook to make it happen. So I'm pleased that we now have both a process and a timeline that's aimed at meeting our commercial production scenario. And the last comment I'll make on this is on this process that we have with the port under the MOU is this. Look, I've been in the infrastructure game for a while, and a large part of my former career before Macarthur was working on massive port expansion projects and new port development right across Australia. And that was specifically in the bulk mining sector. And I'm talking about ports handling hundreds of millions of tonnes annually with 10 to 12 different major operators, major mining companies, mid-level mining operators seeking capacity. So I understand what's at play. I understand what the port's looking for because I've worked for port authorities before, and I genuinely believe Macarthur's now in the best position that it's ever been in to secure access at Esperance and get our product to market. So we'll move on to the next slide, please, Jordan. This one's got a bit of a video on it, and I'm happy, Jordan, if you want to click on the video sooner rather than later so people can get a bit of a look at it, because we'll cut it off before it goes all the way through. Look, you would have seen a series of announcements about our plans to develop unloading infrastructure, and that's necessary because the existing rotary car dumper at the port's old and constrained. So what we're doing is we're proposing a Helix dumper system that's ideally suited to magnetite products like ours. Our magnetite will contain about, as I said before, about 8 to 10% moisture. And so we could use bottom dump rail wagons. It's not ideal because it could have a tendency to stick. It's a system and an infrastructure solution that's ideal for development on the port because it's got a considerably lower vault depth than a conventional RCD, and it's got a high speed throughput. So it's going to bring a state-of-the-art unloading technology to the port, and I've mentioned there it'll be like bringing a Ferrari in there, but at the price of a Ford. I don't know whether the video can get up there. It doesn't matter if it can't, but you can see there from the pictures there that what it involves is actually a tilting of the bucket from the wagon. It rotates at about 148 degrees, so the chassis remains on the rails and it's powered by the locomotive's forward motion. So I think it's the most perfect rail unloading solution on the market for magnetite concentrate. And it's not, although it's state-of-the-art, we're not going to be guinea pigs for it. It's proven its operational suitability for magnetite for Northern Resources in Sweden. They've had it operating there for about the last 5 or 6 years, and it's been doing about 2.5 million tonnes for shipping ore from Sweden to the port of Narvik in Norway. It's been designed by Caruna Wagons. They were awarded a 2017 Swedish Steel Prize for new technology. And RCR, which is a subsidiary of a publicly listed group here on the ASX, NRW, they got the licensing right to the technology in Australia, and they've done the initial engineering design work for us. And the benefit of that, of course, is that it'll create jobs in the region. They're looking to construct the wagons and the RCT here in Australia. Next slide, please. Feasibility study. I think everybody's interested in where we're up to with that. I'll give you a quick update on what's happened. When the coronavirus hit last year, that landed right at the start of the commencement of our options analysis for the project, but that didn't stop us. We covered a lot of ground last year. We worked through a lot of key foundational elements for the study, and we focused on two things. We focused on sharpening our route to market and resolving project options around that, and I've just outlined that. And we also focused on finalising the analysis of the magnetite infill drill program that delivered our measured resource statement in July last year. And that was a major step forward, and I think it was well received by the market. So we've appointed a highly regarded study management consultant in Optimise Group to assist our owners team with study delivery and to ensure we get the appropriate rigour applied to the study report that's going to be produced. Mine planning work is progressing, and we have pit shells and preliminary mine planning and scheduling well underway. There's more work to do, but we've engaged Geology to undertake that work for us, and they're using best practice techniques and technology to assist us to deliver the mining component of the study. The met process package is progressing well. We've got a brand name external consulting firm with global experience in magnetite processing running the met process package for the feasibility study. And we've also got an expert internal mineral processing engineer, Dr. Richard Peck, who's just joined Macarthur to help manage that process with us. The non-process infrastructure package and work scope's being finalised on the back of closing out some of the project options that I discussed earlier, and the appointment of that package of work will be imminent in the next several weeks. In the course of this year, we're going to also see some additional work on site at Lake Giles to support the delivery of the study. So we're going to look at some potential drilling of the hematite cap to target possible generation of early cash flows during the mine construction and to reduce overburden costs. There'll be some additional drilling for metallurgical samples to support the process flow sheet, and we'll be conducting aerial water surveys and waterbore drilling. Look, we're working through all of that carefully and systematically, but the feasibility study's currently still on track for delivery this year, so that we can keep to the target timelines for our financing and development schedule. If we can move on to slide 19 now, please, Jordan, on financing. The project's currently intended to be financed by around 65% debt and 35% equity, but we'll optimise that split as we get closer to the point of funding. I know there's varying views on what that percentage split should be, and we'll look at that closer to the time. We've mandated EAS advisors out of New York to work with us on the debt financing particular, and some of you in Canada may know a little bit about EAS already. They're a boutique global advisory firm. They're focused on backing early stage mining and industrial groups to access US and institutional financial markets and institutional capital. EAS was founded by Eddie Sugar, who was heavily involved in the early financing efforts of Fortescue Metals Group. With them, he was involved in the first bond raise for FMG when it was a minnow, and the rest is history, as they say. We're also continuing to engage and work with a range of groups who have an interest in iron ore in the North American market, and we've got solid interest from a number of top Canadian institutional dealers, including dealers that have worked with and or covered Champion Iron and are looking to invest in quality Australian mining assets. Glencore's also been a strong supporter of our project. They participated, as I said before, in our 2019 convertible note. They don't generally do project financing because that's not their core focus or approach. They're an iron ore trader, but there's always potential for them to come in and support in other ways if they choose to do so. And of course, they did step in and lend support to Champion in phase 1 of Bloom Lake, and they took a seat on the board. And look, we've got a great relationship with them, so we're certainly pleased to have a quality international iron ore trader of their calibre and scale in our corner. Move on to the next slide, on slide 21. Early tonnes. Look, we've mentioned in some recent announcements our intention to pursue an early production target for DSO at our Ularring deposit, so I'll outline a little bit about that. The uninitiated, we've got about 54.5 million tonnes of hematite in the indicated category and about 26 million tonnes in the inferred category at Ularring. The grade's variable and the resource is spread across about 5 separate areas, which you can see on the map there: Snark, Drabble Down, Central, Banjo and Moonshine. It's about as shovel ready as you can get for a project, in the sense that we've got fully granted mining leases, we've got Environmental Protection Authority approvals, including native title, heritage and baseline studies completed. And we've got an exploration history of it, which is very extensive. We've got over 1,800 drill holes totaling about 100,000 metres. If you can move on to the next slide, please. We're examining an export option for up to 1 million tonnes per annum or more if we can manage it, with the ability to scale up where we can identify sufficient transport capacity to match production. Our mining methodology will be a simple extraction of surface hematite with crushing, screening and loading of the ore for transport. And we'll look initially to target the high-grade nodes at Ularring to deliver a plus 57%, 58% product to the market. And look, we're looking to try and do that within the shortest time possible, subject to securing available transport. Obviously, the intention to do that is to get cash flow whilst iron ore prices are at their current levels. The revenue objective would obviously support our investment in the magnetite operations, but I think the biggest focus for me and for Joe and for the rest of the board is the overriding corporate objective to re-rate us as a producer and to improve the basis for funding of our high-grade magnetite project. At the end of the day, all of you have invested in the future, in a future mining company. And as investors, you're keen to see a product being mined and moved and sold, and that's what we're looking to achieve. And nothing will speak louder than our ability to fill the period to first magnetite operations with an early DSO campaign. We've given as much love as we can to shareholders over the last period with the uptick in the share price. And although Valentine's Day has already passed, for those of you who are out there saying, look, Macarthur, I love you, but what have you done for me lately? Watch this space. It remains a key focus for management this year, and I want to make that totally clear. And we expect to provide some more colour to the market and our intentions around that shortly. If we can move to slide 24 now, please, Jordan. We're getting closer to the end of the presentation, but there's a couple of things I want to cover. Iron ore market outlook and pricing. I think everybody's keen to understand what's happening with the iron ore price. That's obviously one of the biggest questions going around investor circles at the moment. If we all knew that answer with precision, then we'd be retiring early. So I'm clearly not going to provide any pricing guidance to anyone on this call, but what I will do is talk about what I'm observing and some of the perspectives that are out there at the moment and what that might mean for Macarthur and its projects. We're going to be producing a magnetite fines concentrate, and as you can see from the chart on that slide, it's a chart we've used before. There's a spread of, between the spot price for 58, 62 and 65% fines prices, and they're in US dollars for dry metric tonne CFR to China. And what you can see is that the price difference between low and high grade iron ores is getting wider. And it's been trending in that direction for a while. So it's clear that these growing premiums for high grade iron ore products is really in response to China's drive to improve the efficiency of its steel industry and to reduce air pollution. And that's been driven by increased regulation by the Chinese government and also by other countries as well. Joe's spoken about this before in previous presentations, but what we're seeing is a clear growth in the use of electric arc furnace versus blast. And that's going to continue to drive demand for magnetite pellet feed, because in EAF you have to use magnetite pellet feed and scrap. And that trend is being demonstrated by a surge in scrap iron prices as well. 62% iron has hit closes of $180 US in the last 12 months. It's currently trading at around $166 CFR, and in the last 12 months we've seen an 87.4% increase in prices year on year. So that's a phenomenal performance amid a global pandemic. But it's also not surprising because the strong price performance is being fueled by global stimulus. Midway through last year, McKinsey published a report which estimated that total global stimulus at that stage was $10 trillion US dollars and rising. And the economic stimulus response to COVID has, I think, far exceeded the 2008 economic crisis. But the nature of that stimulus has also changed. So around 60% of stimulus measures that were announced in March were liquidity injections because they needed quick-acting delivery mechanisms. But that's estimated to have fallen to around 15% as other measures are coming online. And around 30% of that stimulus, give or take, analysts are saying, has been estimated to be based on hard infrastructure spending requiring significant quantities of steel. And like most economic downturns, what we're seeing is efforts for a construction-led recovery. In 2014, and I'm just taking back to another study here, but the International Monetary Fund found that an unanticipated increase in capital spending of about 1% of GDP leads to about a 0.4% uplift in output in that same year, and a 1.5% rise 4 years later. And I've seen estimates that a deviation from the baseline GDP with an economic lockdown during COVID where the construction sector remains open is around -4%. But if you lock down the construction sector as well, then that number starts to triple and gets closer to 12%. So it's no wonder governments have been trying to keep the construction industry moving. I'm sure you've seen that in Canada, and we're seeing that here in Australia as well. China's dual circulation strategy seems to be triggering some concerns that China's becoming a bit more inward looking, and that's resulting in a policy reorientation, and that's going to see it become less reliant on certain strategic imports in the coming years. A number of countries have fallen victim to that in the last 12 months, Australia included. I don't think COVID's caused that. I think China is an emerging superpower, and like any superpower, what it wants to do is it wants to project that power and test limits. It's on a course, and I think maybe COVID's accelerated and amplified it to some degree. But to be balanced, I think COVID is causing pretty much every country on the planet to rethink their supply chain security. And China seems to be focusing on a number of commodities, food, agricultural tech, and some energy products like oil and gas and coal and battery mineral products. But tacked onto the end of that list has been the question around iron ore, and there's been a lot of press around the Simandou project in Guinea and what impact that could have on global iron ore supplies, and whether that'll put downward pressure on prices in coming years. That's a valid question when you're considering an investment in iron ore. China's always going to look to maintain access to global supplies of iron ore, but in the long run, it naturally wants to build its own capacity to some degree. And that's why I think Simandou has been labelled the Pilbara killer. But I think the significance of the Simandou project in terms of its ability to deliver a painful, I'll call it a nut punch to Australia and Brazil and other countries that are producing iron ore has been exaggerated. And there's a number of reasons for that. It's a $14 billion project. It's targeting 60 to 80 million tonnes per annum in 5 to 7 years. The rail and port infrastructure is going to be another 12 billion. It's an incredibly expensive project and it's been on the shelf for 15 years because of the construction costs, political instability and the regular Ebola outbreaks. And I think there's even been another Ebola outbreak in Africa announced in the last week or so. So it's a challenging environment to get a big project up. I think we have to assume that China will get it across the line. But when you look at the numbers, many analysts are saying that its impact on Australia's share of the iron ore trade will be relatively small. 68% of our iron ore goes to China. They import about 70% of the world's iron ore. That actually increased to about 75% on the back of stimulus last year. It's the world's biggest producer of steel, produces about 1.1 billion tonnes each year. And that means it's very heavily reliant on Australia and Brazil. So big iron ore projects like Simandou have got long lead times and it's going to be very difficult for them to decouple from traditional sources of supply in a material way, and certainly not in a short period of time. When it comes online, it'll probably account for about 3% of the seaborne iron ore trade. If it eventually expands to 150 tonnes per annum, as some people expect, then we're talking about 7%. And if you look at that, then some analysts are predicting a pricing impact of around $8 to $11 US a tonne. So it's certainly something to consider. But the other thing to remember is that Guinean iron ore is going to have higher shipping costs because of the longer haul distance to North Asia. And as Joe and I like to say, you can't beat geography. And Western Australian iron ore has got a very decent freight advantage when compared to other regions. So all of that, I think, still places Australian iron ore in the region of about 50% of total worldwide supply over the next few years. So I think those Gilbert killer claims can rest for a while. But that being said, what are iron ore prices likely to do over the next few years leading into the initial production phase for our Magnetite project, and how are we going to approach that in assessing project economics? I'll address that first question first because it's the most simple. And the short answer is we're going to be adopting a conservative approach to forward pricing forecast in our modelling. It's not an entirely valid comparator because it was a different project scope, but our May 2019 preliminary economic assessment report, which was an NI 43101 technical report prepared for the Canadian market back then, assumed an iron ore price of around $86 a tonne. Now that was $86 for 65% fines product. We're still targeting that product grade, and we'll adopt an appropriately conservative long-term forecast in our model. So I think that's where it's sitting. I think a lot of pundits have already got, even getting closer to the end of last year, predictions on iron ore prices quite wrong. There's going to be pullback on the iron ore price. There's absolutely no doubt about that. I mean, we're trading at pretty good levels already. But I think the outlook is generally robust, and we don't consider that the current price forecasts are going to impede the path to production, even with some pullback over the next few years. But we're naturally going to build some conservatism into that. If we can move on to the next slide, please, Jordan. We're getting almost there now. I just want to touch briefly on magnetite and why magnetite as a product. And why it's important in terms of where we see future product demand and pricing being driven. We've talked about the magnetite as being a product with unlockable green attributes for the last couple of years. We've been leading that narrative here for a while with our little megaphone. I think there's been a few bigger megaphones with some gold plating on them around there at the moment that are starting to echo the same potential, and I think that's good for the industry, so we welcome it. We're serious about it. We're branding ourselves as the Green Iron Ore Company, but that's not a trite slogan. Macarthur wants to limit its impact on the environment, and I believe that we're targeting mining of a product that's got true green potential and it can deliver better outcomes in terms of lower emissions. It's something that both Joe and I are passionate about, and I think Macarthur as a company has an opportunity to pivot into that space well. There's certainly a difference between low-grade hematite iron ore and magnetite. It's significant. Their properties are different. The way they behave in the furnace is different. As I said before, it's much more efficient in the furnace. It's got lower potential for lower production costs because it's less reliant on coking coal. and it emits fewer impurities into the atmosphere. So apart from the environmental benefits, though, there's actually a very good economic basis for moving to a greater reliance on higher grade magnetite as feedstock. You can see there on the slide, and McKinsey have estimated that as we move through the next few decades, 14% of the potential value of steel companies is at risk if they're unable to decrease their environmental impact. And a lot of countries are moving on this. The United States has a change in administration, and they're making some really big early decisions. So the decarbonisation of the global industry is going to be a very, very important component in the march towards meeting a 2015 carbon neutrality target under the Paris Agreement. One of the interesting things that we're seeing is that whether you're living in a country that signed up to the Paris Agreement or not, and Australia still hasn't, it's inevitable we're going to see supply chain management at both government and private sector levels tightening around the requirements when making decisions on construction inputs. We're already seeing that in many companies like Volkswagen and Toyota looking to eliminate carbon emissions completely from their value chain. And institutional investors are moving on that too. So there's an institutional investors group on climate change, which is a global network of about 250 investors with over $30 trillion in assets under management. And it's raised expectations for the steel industry to step up efforts on decarbonisation. We've seen BlackRock also confirming its commitment to environmentally responsible business development and sustainable investing. So it's happening. It transcends politics now, and it's a socially driven agenda, and the industry is just going to have to respond. But that's great news for magnetite, and it's great news for companies like Macarthur who have large holdings of it. Next slide, please, Jordan. This slide's been seen before. I'm not going to spend a lot of time on it because I'm conscious on time. Joe's spoken about it before, but it just gives you the life cycle of where we're moving from the Stone Age through to, I guess, the end of the closed loop on the green steel spectrum, and where we're moving along the decarbonisation path, eventually to electric arc furnace using hydrogen as a reductant, with your only output being water. And that can happen in the medium term. And I say the medium term because we're starting to see more rapid advancement in technology in response to an acceleration of those regulatory measures. So at the end of the cycle, as you say there, it's a pretty good outcome. And as I've said before, only magnetite iron ore can get us through that process that I've just described. If we can move to slide, I'll skip the next slide, please, Jordan, move to slide 28. I've covered off some of that stuff before. Look, the decarbonisation discussion wouldn't be complete if we didn't have a quick discussion about what Macarthur's vision is for its operation at Lake Giles. We need to have a green production pathway. We're not walking the talk. So what's our vision and how are we going to approach it as we build out our mine and we close the green loop of the production cycle? Well, firstly, we've got to generate cash flows. Nothing happens without that, but we will have a plan to incorporate an integrated energy solution at the mine that provides a lower levelized cost for energy delivered to the site. And that has to consider a mix of energy inputs, including an appropriate component of renewables to penetration. And we're certainly at a point in the technology cycle where it makes economic sense to integrate it. We're in a remote location, but it's achievable. And what we'd be looking to do is get a delivered energy solution under a power purchase agreement with an independent power producer, an IPP. And they can develop the power generation and reticulation assets across the project area and then deliver a dollar per kilowatt rate over the term of the contract. The key for us there is to arrive at a model where we have an IPP that's also obligated to meet progressive increases to the percentage of penetration of renewables over the life of the contract. And that can include a combination of solar or wind and hydrogen replacing fossil fuels. So there's a real shift that's possible there. The cost of hydrogen production will inevitably come down. It'll be led by grey hydrogen that's going to initially be fueled by gas inputs, but the Hydrogen Council's predicted that green hydrogen prices, and that's hydrogen produced from renewables, could halve over the next 10 years. And there'll be a corresponding fall in the cost of electrolyzers as scale-up occurs. Next slide, thanks, Jordan. Look, we're already in discussion with a number of partners on energy sources that we're going to consider for our feasibility study. We're looking at optimal percentages for solar and wind penetration and reviewing that. We're examining options for early adoption of hydrogen technology where it makes economic sense for it to be rolled in. But we're only going to adopt and integrate where we can be assured that we're going to get pricing benefits relative to conventional energy sources, and provided that we don't assume capital or technology risk associated with rollout. And I think that's the smart way to do it. Someone once asked me what a green mine looks like. And I think the premise of the question was that they didn't believe it was possible to have a green mine of any sort, and that a lot of discussion in the industry around it was a bit rhetoric. It wasn't put offensively, but I took it as a challenge, partly because of my background and knowledge in the energy and renewable sector, but also because I think that those in the mining industry who are working hard to support our economies and to deliver royalties and taxes that provide material funding for health and education and social infrastructure and the environment deserve to have their dignity and respect restored in a world that's become very partisan on the issue of climate change and very prone to labelling. You know, we all live on this planet together, and the mining sector in Australia and in Canada is an industry of good, hard-working people with families who really value the environment just as much as the next person. So we intend to operate with the highest levels of environmental responsibility. And on the energy front, our principal objective is to have a clear timeline to achieve 100% green iron ore production with zero net emissions, and to be a world leader in that area. And size doesn't matter when it comes to achieving that. We can move nimbly, and as an emerging producer, I think we've got a responsibility to do that. That can't happen from day one in a startup operation, but we can and will have a clear framework for that to achieve it in the shortest possible time frame, and it's certainly going to form part of the company's KPIs going forward. Look, I've spent a bit of time on this issue, not to monopolise the agenda and take it off the track of discussion of the project fundamentals, which everyone wants to hear about, but because I think it's important to understand where the market's shifting and to understand Macarthur's future place in that new world order with our high-grade clean feed product, and what we're intending to do to converge with that future. Because ultimately that's where the real value of your investment dollar will sit if you continue on the journey with us. The last slide was just about the Macarthur delivery team. I'm not going to spend a lot of time on that. You've seen all of us before, but I'll just say, look, we've got quite a small management delivery team at present. It makes us quite unique in terms of what we've been able to achieve. If you look over the last 12 to 18 months, we've achieved an awful lot in a short space of time. I've come from a pretty demanding industry where you don't get a lot of work-life balance, so it really surprised me when I came across to Macarthur to see just how hard this team works every day. Investors don't get to see that. You see independent news releases with a couple of lines that summarise some really hard graft. And I don't think I've ever worked alongside a team that's so dedicated and hard-working as the crew that we've got here. And I can absolutely say that I think every individual on our team works like 3 people. So with the volume of deliverables that we're working on, the huge amount of regulatory compliance that we have, I think we're really making things happen. So we'll look at an expansion to that team over 2021 at an appropriate scale through the addition of consultants and direct hires, and that'll be to add value to shareholders and delivering a bankable project. We've got all the required skill sets we need to this point, but the next critical phase of getting the project out of the ground will require some careful selection of senior experts with the right experience, and so I'm going to work with our board and our General Manager of Projects, Dr. Dan Carter, to get that mix right, so that when you start seeing bulldozers, concrete pipes, equipment, machinery, all moving into place, you can be assured that we're set up operationally to deliver this thing. And that's the next phase in our growth, and we have a clear understanding of what that'll look like and who we'll need. So that's all I had to present on. I'm sorry that's been a bit of information, but thanks for the opportunity to speak today, and I hope that you found it informative. And I'll hand back to Neil to moderate, and if we've got time to answer any questions, I'll do my best to answer them.
Thank you so much, Andrew, for going into so much detail there. Really appreciate it. We are after 5 at this point, but there's one question that keeps popping up in the Q&A. Those of you who would like to ask a question, please feel free to do so in the Q&A portion of the webinar. We're only going to answer this one question today because we are over time, but we will go ahead, collect all of your questions, and then pass them along to Andrew and Joe if necessary to answer those questions, and we'll get those answers back to you at some point next week. But this is the one question that keeps popping up. So Andrew, what are the plans with the lithium and gold projects? Because they're not exactly related to the iron ore projects. Can you speak to a little bit about if there are any plans with regards to those properties?
Yes, certainly. And look, Joe alluded to that before in the introduction, where he was talking about a repositioning of the non-iron ore assets that we have here in Australia. Look, we've certainly got plans underway for that. I think the market can expect some imminent announcement about that in a very short space of time. Our key focus is the Magnetite project and to getting early tons out on DSO, and I think that the market wants to see us focusing on that. But we also want to ensure that we've got some valuable assets over there in the Pilbara, in that region with those assets, and they want to see value delivered out of those. I can assure you that what we're working on at the moment and the announcement that will be made on that will, I think, be something that investors will be very heartened by, and it will provide the right area of focus for the future development of those assets, and it will provide enough space for Macarthur to ensure that we're focusing 100% of our management resources here on getting Lake Giles into production. So I'd like to say more on that if I could, but I don't want to preempt announcements that are coming out to the market on that. But rest assured, that announcement is imminent, and I expect within a week or less, perhaps, we'll have something out to the market to digest on that.
Awesome. Well, thank you so much, Andrew, for joining us. And on behalf of everybody who has joined us here today, thank you for getting up so early and taking the time to share the Macarthur story with us. So many details and answering a lot of questions that people had before this call. So thank you again for joining us here on the webinar.
Thanks, Neil. And yes, as we said, if we've run out of time on questions, we're very happy to answer any follow-up questions that come through from investors after this, and to get back to you individually.